It wasn't a glitch in the trading algorithms. It wasn't a momentary lapse in diplomatic judgment. It wasn't even a simple escalation of a trade war. It was the mechanical grinding of a geopolitical cycle that has destroyed hegemonies for 2,000 years. The pattern is unmistakable. When a dominant power faces a rising challenger, it eventually abandons the free markets that built its wealth. It turns to coercion. It turns to walls. It turns to tariffs. And the arithmetic is merciless. The $2 trillion evaporated from US markets is not a correction. It is a signal. It marks the moment where political desperation overrides economic logic. But this has happened before. The sequence is rigid. It moves from peak dominance to overextension, then to protectionism, then to capital controls, finally to the fracture of the currency itself. History provides us with 3 perfect case studies that prove this is not a modern anomaly. It is a recurring historical inevitability. The first instance is the Roman Empire, specifically the crisis of the 3rd century. Under the Severan dynasty and later emperors like Diocletian, Rome faced a critical breaking point. The empire had reached peak dominance, but the costs of maintaining the legions and the bureaucracy had become mathematically impossible. The state could not tax enough to pay the bills, so they chose the monetary shortcut. They debased the silver denarius, mixing it with copper until it was worthless. Inflation exploded. Merchants hoarded goods. Trade networks collapsed. In response, the state did exactly what modern powers do. They imposed price controls and trade restrictions. In 301 AD, Diocletian issued the Edict on Maximum Prices. It was a desperate attempt to legislate value. The penalty for violation was death. Yet, the economic laws overrode imperial decree. Goods disappeared from the markets. The economy bifurcated. The wealthy fled the cities to fortified estates, converting their wealth into land and hard assets. The urban middle class was crushed. A soldier or a baker in Rome found their currency rejected by traders in the provinces. The unified market fractured into isolated, survivalist economies, just like Rome. The Spanish Empire in the 16th and 17th centuries walked the same path. Spain controlled the global reserve asset of the era. New World silver and gold. They had absolute dominance. But the crown's ambitions in Europe required endless wars. The costs were unsustainable. Rather than developing domestic industry, they relied on the influx of bullion. This was their monetary shortcut. The result was the price revolution. Costs in Spain soared. Spanish goods became uncompetitive abroad. Instead of reforming, the crown relied on protectionism and rigid control of trade routes. They tried to force colonies to trade only with Seville. The incentive was to ring-fence the wealth, but the market found a way around the walls. Smuggling exploded. Capital fled to the banking centers of Genoa and Amsterdam. The Spanish middle class was hollowed out by inflation and taxes. A merchant in Castile could no longer compete with Dutch imports. The empire defaulted on its debts multiple times, famously under Philip II in roughly 1557, 1575, and 1596. The wealth seizure was indirect, but total. Those who held the currency lost everything. Those who held land and title survived. Just like Spain, the British Empire in the 20th century completed the trilogy. By 1914, Britain was the financial center of the world. The pound sterling was as good as gold. But 2 world wars and a massive welfare state broke the balance sheet. The costs were unpayable. The monetary shortcut was the suspension of the gold standard and the devaluation of sterling. As American industrial power rose, Britain could no longer compete on price. So, they turned to tariffs. The Import Duties Act of 1930 ended the era of free trade. Britain created the system of imperial preference, trying to lock its colonies into a closed trading bloc. It was a defensive crouch, but the capital controls and tariffs could not stop the bleeding. By the 1960s and 70s, the British disease had set in. Inflation eroded savings. The IMF had to bail out the UK in 1976. The middle class, facing stagnant wages and rising prices, saw their standard of living collapse relative to the rising powers of the East and West. The empire didn't end with a bang, but with a series of currency devaluations and a retreat into irrelevance. The pattern repeats in 7 distinct stages. Stage 1 is the era of good money. The dominant power is productive, runs surpluses, and its currency is trusted globally. Stage 2 is the expansion of burden. Social programs and military commitments grow larger than the tax base can support. Stage 3 is the monetary turn. The government realizes it cannot raise taxes without revolt, so it begins to print or borrow excessively. Stage 4 is the inflationary spike. Prices rise, and the state blames speculators or foreign actors rather than its own debasement. Stage 5 is the protectionist reaction. The state imposes tariffs, capital controls, and price fixes to stop the bleeding. This is the stage where trade wars begin. Stage 6 is the flight to hard assets. Smart capital realizes the currency is broken and flees into land, gold, and commodities. Stage 7 is the fracture. The currency loses its status, and the middle class is wiped out as the economy resets to a lower baseline. Just like the British Empire in 1932, the United States has now firmly entered Stage 5. The imposition of 145% tariffs is not a sign of strength. It is a defensive wall erected by a power that can no longer compete on a level playing field. The loss of $2 trillion in market value is the immediate repricing of this new reality. The incentive is to protect domestic industry, but the arithmetic is merciless. When you block cheap imports, costs rise. When costs rise, margins collapse or inflation accelerates. Simultaneously, we see the rising challenger, China, engaging in Stage 6 behavior state-directed accumulation of resources and capital. Controls to prevent flight. The surge in Chinese markets, despite the tariffs, suggests that domestic capital is being trapped and forced into equities, or that state intervention is artificially propping up the numbers to project strength. It is a battle of attrition. Current data suggests that while the US tries to inflate away its debt behind a wall of tariffs, the global financial system is beginning to fragment. The weaponization of the dollar has accelerated the move toward alternative settlement systems. One interpretation is that these tariffs will successfully reindustrialize the American heartland and restore balance. Proponents argue that the pain is temporary and necessary to decouple from a strategic rival. However, this view ignores the constraints of the bond market. The US requires foreign capital to fund its deficits. If tariffs slow global growth and reduce the surplus capital available to buy treasuries, yields must rise. Higher yields blow out the deficit further, requiring more printing. The feedback loop is positive and destructive. History shows that protectionism in the late stage of an empire does not reverse the decline. It merely accelerates the inflation. We are left with 3 potential endgames. The first is controlled decline. This looks like Britain in the 1950s: a slow, grinding reduction in living standards, persistent inflation, and a gradual loss of global influence. The second is chaotic collapse. This resembles the Weimar Republic in 1923, where the currency is rejected entirely, and the economy halts until a new hard currency is introduced. The third is reset and restructure. This is the 1940 for Bretton Woods scenario, where the global powers convene to write new rules for a new reserve system, likely involving a basket of currencies or a link to commodities. The only variable is timing and pain. Subscribe to the channel. Focus on education. Build resilience. Watch the data, not the headlines.